This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Geopolitics ain't the economy, and the economy ain't the stock market. Avoid drawing straight lines in your thinking and understand that corporate America continues to blow away expectations. Up next, what's driving stock prices? It's earnings, stupid. Let's discuss. Welcome on board another edition of our Wise Investor Group podcast. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. Forgive me, I'm going to kind of punt on Iran today. It's such a fluid situation right now that me offering some comments on what's going to happen there or what the headlines are going to be could age very poorly. So I'm just not going to get into it. But just in a general sense, I can tell you, I don't think it's a coincidence that this market started turning around right as we started getting first quarter earnings reports, right? The market has been caring more about earnings and maybe more about AI than it has about Iran. Stay tuned. I'm going to get to that in much more detail over the course of the next few minutes. But as we all know, we had a furious rally in April. You're probably getting your April statements and seeing, I would think in most cases, maybe not all cases, but most cases, market improvement from your numbers in March. Really, the story was technology. The tech index went up something like 22, 23% in April. Semiconductors in particular were up 27% and up an amazing 18 days in a row. Pretty unbelievable. Meanwhile, no other sector, by the way, besides tech was up more than 10% in the month. So tech was definitely in the driver's seat. At the same time, the volatility index, the so-called VIX, V-I-X, plummeted by 43% over the course of the last month. 43%. According to FactSet, that's the fifth biggest volatility crash decline in history. You might ask, well, what does that mean going forward? Well, FactSet noted that if you go back to 1990 and you look at all the other, the largest 15 volatility crashes that we've had, sends a pretty good signal going forward. Over the next 6 months, S&P averaged almost a 10% return versus 5.8% overall other periods. 1 year, almost 20% versus 12.1% in all other periods. So when you get this type of volatility crash, the precedent is bullish. Meanwhile, since 1990, there have been 94 times when the volatility index got to over 30, like it did in March. Same sort of picture. Average forward returns, again, this is FactSet data, for the S&P over the next 3 months, up 5%, 6 months, 9%, 12 months, 13%, with positive hit rates of 70%. So again, past performance is no guarantee of future results. We all know that. Anything can happen. But when you get this type of major correction in volatility from a high, it's generally a positive indicator. Same thing goes if you look at other metrics. Sell-offs tied to oil shocks have traditionally been short-lived. This is from Charlie Bolello. He writes a financial blog. Generally speaking, again, going back to 1990, when you've had an oil shock, 2 months later, S&P up 1.4%, 1 year later, up 12%, 2 years later, up 32%. One more I'll just give you. I don't want to belabor the point. But when you have extreme consumer sentiment pessimism like we've seen some of the worst consumer sentiment readings ever recorded. Same type of deal. 1 year returns in the S&P after consumer sentiment has bottomed, and again, we only know that it's bottomed in retrospect, but it did hit a trough. You look at the Volcker inflation shock in 1980, Gulf War 1990, 2008 financial crisis, 2011 debt ceiling crisis, COVID, so on and so forth. Average return for the S&P, 28.5% over the ensuing 12 months. Take it all with a grain of salt. We don't know what's going to happen. But some of the extremes that we saw less than a month ago are generally something to be positive about going forward, not negative. And the same thing goes, I get a lot of people asking, okay, the market's rebounded significantly. S&P's back to an all-time high. Dow very close to an all-time high as of this recording. Well, since 1989, this is also Charlie Bolello, the forward returns following all-time highs are actually slightly above average. So buying at the high, if you have a bunch of cash and you put it in today, historically, who knows about the future, but historically, you've done better, not worse, than an average year. I say this all the time. Don't fear the market doing well. Okay, there's this temptation that you have to buy the dip. Well, not necessarily. And quite frankly, same thing goes if you look at the performance since some of the recent highs. I found this really interesting. This was from the guys up at Ritzold Asset Management. This is as of a week ago, I believe, so it didn't even capture some of the gains this week. As of a week ago, they looked at the performance of the S&P since important market tops over the past 15 years. Well, had you invested the day before the start of the Liberation Day sell-off last spring, S&P's up 15% since then. From the peak just before the start of the 2022 bear market, up 54%. From the peak just before the COVID crash, 124%. From going all the way back to the peak in October of 07 before the financial crisis, up 524%. Not bad, right? Considering that those previous peaks were followed by drawdowns of 19%, 25%, 34%, and 57% respectively. What's the point? We all get caught up in timing, whether we do it consciously or not, right? We're always trying to buy the dip. We're always trying to wait for the market to pull back before we put money to work. Well, yes, can that add some value if you get it right? Sure, for sure. But it's okay if you're unlucky. It's okay if you buy at the peaks, you buy at the market peaks, or you buy right before a correction. Odds are, over a longer period of time, you will eventually be rewarded for actually being invested versus trying to time the entry point. Along those lines, I've been saying this for a long time, and it's hard to put real math and science to it, but things happen a lot faster these days, right? And everything, not just stock market. I mean, according to Bespoke Investment Group, the last 30, 45 days is the first time in the past 100 years that the S&P has made all-time highs in 11 trading days or fewer after falling 5 to 10%. First time it's ever happened. Market is supposed to take the stairs up and the elevator down, right? That's the old cliche. The past 10 years or so, it's been the elevator down and then the elevator right back up again, right? We saw that Liberation Day last year. We saw it with COVID. Not all the time. 2022 is a little bit more of a slog, but we've had more V-shaped recoveries, right? And it's not just in stocks. I mean, look at labor markets in the last 5-6 years. We went from 3.5% unemployment before COVID to 15% unemployment, back to 3.5% just in a couple years. Oil, $60 a barrel in 2019, went to negative 37. Remember that during COVID? Back up to 120 when Ukraine and Russia broke out, back to 55 a few months ago, now up in the 90s, right? I could say the same thing about interest rates, same thing about inflation. What's the point? Everything is moving quicker, not just stock prices, asset classes, and economic variables. Why is this? Well, certainly the information age has something to do with it, right? I mean, information is shared basically instantaneously, right? You don't have days and weeks to kind of stew through a newspaper article, right? It's instantaneous. Government intervention, we all know about that, the role of not just our central bank, but central banks around the world. We just get these big moves from very aggressive central banks everywhere. And I would also say the rise of technology with respect to trading. I mean, these trading algorithms, trading programs, they are moving billions of dollars of stock or other asset classes instantly, right? I mean, some of these things are trying to catch trades in fractions of a second. So that creates some real leverage in the system. I'm not necessarily saying that this is good or bad. It just kind of is what it is. And by the way, you're also seeing this on an individual stock basis. I don't know, you probably don't follow things as closely as I do, but I have 200 stocks on my screen, and I got to tell you, it's amazing the last couple of weeks. 5, 10, 15% daily moves used to be kind of a rarity. It would only happen if a company came out with great news or terrible news. Not the case anymore. I was just looking today. There are a ton of stocks on my screen down 3, 5, 7% or up 3, 5, 7%. Really on nothing. Really on nothing. Very, very minor headlines, or maybe just guilt or reward by association, right? There's so much index trading now, ETF trading, sector trading, that if it's what's good for one stock is often good for another stock and vice versa in a particular sector or industry space. So, what's my takeaway on all this? Well, be prepared to be wrong more than usual, right? When you get some of these big moves. Somebody once told me that it's okay to have strong opinions, but they need to be loosely held. You need to be flexible. Things change. I think the temptation to trade goes up exponentially, right? We had this kind of gambling mentality in our society right now where there's a lot of FOMO. You see these big moves and you fear that you're missing something. Or the reversal, right, of that, the flip side of that, you get spooked out of something that has a big decline. I think the biggest takeaway is you have to be in control of your emotions, right? And that's, quite frankly, why I have a job. I have a job because I can take some of that subjectivity out of it for our clients and make decisions based on news flow, facts, rather than emotional swings. But if you're a do-it-yourselfer, you've really got to work hard to keep things in check. All right, back to the here and now. I mentioned large cap tech has snapped back. It's been a pretty circuitous 9, 12 months, right? For the first 10 months of last year, it was all AI all the time, right? Huge percentage, don't have it in front of me, the exact percentage, but big percentage of S&P return last year was at least 55% came from AI-related names, and really a handful of AI-related names. But then come Halloween, early October, the script flipped, right? Tech became the worst place to be. We saw other sectors like healthcare, financials, industrials do better. And that persisted up till, quite frankly, a few weeks ago. Now we flip back the other way. As I mentioned at the top of the show, tech has far and away taken the market higher here, and you've actually seen leadership in the market shrink. Fewer names are participating. I saw from Connor Bates, he's a trader that I follow, technology is breaking out to fresh all-time highs relative to the S&P, surpassing the dot-com era peak. Meanwhile, the Dow, which offers broader diversification than the S&P, even though the S&P has, of course, many more constituents, it's much more concentrated in tech. The Dow has a lot of exposure to financials, industrials, healthcare. I don't think it's an accident that it's just about at its all-time high. It is not broken out in the way that the S&P has. And certain sectors have not participated at all. Yes, tech has done well. Both financials and healthcare, which are two of the largest sectors in the S&P, are still negative for the year. Actually, I think both are underperforming the S&P by over 15% so far this year. And healthcare is making new all-time lows versus the S&P. So I say all this because if you're looking at your portfolio and saying, man, I've got, 4, 5, 6 stocks going up, but a bunch of stocks in the red, hey, that's the deal right now. That's the landscape. What does it tell me? It tells me, keep your diversification, keep your portfolio spread out. We could be talking 2 or 3 months from now, it could flip back the other way where healthcare and financials start to lead again. In fact, that's kind of what I hope happens, to be honest. The broader the market, the healthier the market. But right now, just a few names are doing the heavy lifting. I will also tell you, and this is very interesting, I saw this in Bloomberg, they graphed what they call high-quality stocks versus low-quality stocks, and they have a number of metrics involved there. Balance sheet, earnings predictability, free cash flow, what have you. But anyway, low versus high. Low quality stocks over the last 6 months, I think it was, are completely blowing away high quality stocks. So if you're sitting there with, blue chip healthcare name, financial name, and you're wondering why you're not making any money, well, that's kind of where we are. But that could change. I think what you don't want to do is start chasing the trade du jour. That's how you get in trouble. Let's shift gears a little bit. I mentioned at the top that I don't want to get too much into Iran. I think the biggest observation that I would make in the current environment, and I've made this observation about probably a few hundred times over the past 20 years on the show and now the podcast, I think one of the biggest mistakes, maybe the biggest mistake individual investors make is they try to draw a straight line between geopolitics, the economy, and the markets. Okay? In other words, they think, and I'm not being accusatory, by the way. I'm just saying I see it all the time. People think there's a straight line between those three things, right? In other words, oh my God, Iran's a mess, Middle East is going crazy. That must mean the stock market is bad. Certainly, the markets get spooked, right, as we saw a few weeks ago. But there's no straight line. There's no straight line, even if there were a straight line between these things, okay? The timing may not sync up. Right? And, stocks, for example, are often 6 to 12 months out in front of the economy, right? And certainly geopolitical events, as we talked about, tend to have a shorter shelf life than actual shifts in fundamentals. So be very careful trying to get caught up in kind of first level cause and effect thinking. From years of experience, it doesn't work. And it's kind of pretty easy to see why. I mean, companies can juggle their business costs much more easily than countries can, right? If you're Walmart or Amazon or whoever, you can adapt to a situation more than a country can shift their defense spending or their pension obligations or their tax system, right? I mean, Meta last year generated more than $200 billion in revenues. They're going to generate those revenues regardless of whether their users can afford to buy a house or not. Data centers are going to be built at a frenzied pace regardless of whether middle-class citizens are going to restaurants or not. And I'm not trying to be flippant about it, but companies, of course, over long periods of time will directionally correlate with the economy. I mean, if we're in a recession, companies are going to feel it, right? I'm not being naive about that. But companies have different metrics, different levers that they can pull to be competitive even in challenging environments. And like I said, geopolitical shocks tend to move prices faster than they move fundamentals, right? And that's what we saw this time around. I mentioned this a couple weeks ago. When Iran broke out, believe it or not, earnings estimates have actually gone higher over the last 30 days, not lower, higher. And remember, the key point, stock market doesn't necessarily care about what's happening today. I mean, they might for, very briefly, but mainly about how things look in the future. That's why often the stock market doesn't make sense. The market is looking past to what's next. And it's pretty clear right now, quite frankly. And one of the reasons I don't want to talk too much about Iran is because earnings and AI seem to matter a hell of a lot more to the stock market than Iran does. All right? That's kind of the reality. And here we are. We're most of the way through first quarter earnings reporting season. Earnings growth, if you back out one-time benefits and some miscellaneous items, is tracking at roughly 16% growth year over year. 16%. That's up from about roughly 13%. Actually, it may have been closer to 12% that was expected just a month ago. So estimates for the rest of the year are actually going up as well. Now, I will say a lot of this growth is coming from tech. Some of these upgraded forecasts for earnings growth later this year, in some cases just as narrow as the actual leadership in the market, right? So it's not across the board. But I will say what is kind of across the board is profit margin strength. We continue to be at an all-time high in profit margins, and that is across almost every sector, not just tech. That's pretty significant. And again, I said this a few weeks ago about oil. I mean, I don't know what's going to happen with Iran, whether oil will continue to come down like it has over the past week, or if we'll get another spike at some point if something develops. But I think it is worth looking at the actual relationship of oil to margins. And this came from Bank of America. They basically said energy costs are not a significant cost component for most industries. They estimate it's less than 5% of total S&P 500 operating costs. Now, again, we know that there are other things being impacted by this strait being closed, right? Helium prices, fertilizer prices. But on the face of it, not as much of an impact as you might think. So do some back-of-the-envelope math. If energy prices rise, let's say 20%, and energy represents 5% of your costs, then your costs have gone up by 1%. Not significant. Can be easily offset in other places. Meanwhile, at the consumer level, energy spending as a percentage of disposable income has fallen for almost on a line since the late 1970s. At that point, when Jimmy Carter was in office, it was over 8% of disposable income. We're down somewhere in the 3.25%, 3.5% range, according to U.S. Bureau of Economic Analysis. So again, I'm not going to sit here and tell you it doesn't matter. Of course it matters. But do oil spikes create enough of a headwind to drive us into recession? I'm not so sure about that. Meanwhile, I saw something from Goldman this week. They looked around the globe, they looked at Europe, they looked at Asia, and they said, quote unquote, the impact on economic activity has been less bad than feared. So it's not just here in the U.S., you're seeing it elsewhere too. All right, I'll leave it there. But again, if you're wondering why the market has picked up over the last few weeks, sure, part of it is the hope that we'll get some, lasting resolution in Iran. That's certainly part of it, right? But I think the bigger part of it is that the market has returned its focus to corporate fundamentals, and over a long period of time, you can sync up a chart of earnings growth and stock market growth, and they are in lockstep. This matters. Same thing happened last year, right? Tariffs came out. Everyone feared the worst, feared a profit margin collapse. Guess what? We got double-digit earnings growth. Stock market had a good year. We'll see what the future holds, but that's kind of an explanation for what's been going on. All right, stay tuned. As I mentioned, we're still in the throes of first quarter earnings reporting season. I do want to highlight what I've heard from some of our top holdings. Chase started that conversation last week, but I have some other names to get to. Back in a sec. Every asset class, equities, metals, oil, and treasuries seem to trade more and more like crazy meme stocks. Discipline and patience are lost arts. How do you keep focused when others don't? Tune in every week as we discuss the latest financial trends and what investors need to know. To keep your eye on the ball and become a better informed, wise investor, listen to us at The Wise Investor Show at RaymondJames.com/The Wise Investor Group. Or just find us on your favorite podcast app. Raymond James and Associates Incorporated, member New York Stock Exchange, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the Wise Investor Show. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. As mentioned, we are in the latter stages of first quarter earnings reporting season, tracking overall about 16% growth year over year, according to FactSet. Did want to highlight a few individual names. Remember, If you're a client of ours and you own these names, I think you can feel comfortable that we've done our due diligence and feel that you're appropriate for your particular situation. If you're not a client, it's really important that you do your own homework, your own research, make sure that they're appropriate for your situation. Also, the names I mentioned, we own for many of our clients. I also own personally, so that would represent a conflict of interest. I have to mention Apple. We all know Apple. I think what was encouraging about their quarter, there was a really good piece on this from our folks here at Raymond James. They note that their sales beat estimates, their revenues and bottom line net income beat estimates in every geographic region in the world. I thought that was really significant. Remember, in the past few years, there's been concern about their China exposure. Well, China hit an all-time high. We're also seeing really good momentum on the service side. Okay, they guided up for 16% year over year for the quarter coming forward. And we're even slightly better than that this most recent quarter. They estimate now that they have 2.5 billion active devices out there, in the world, up from 2.35 billion a year ago. So what are they doing? They're monetizing those 2.5 billion devices, right, with Apple Pay and App Store and music library, all these add-on services that generate consistent fee income for them. Of course, the big news for Apple is Tim Cook's retiring, right? So we'll see how the new CEO does. He's been with Apple for many, many years running their hardware division. So I don't think there's a lot of kind of surprise or execution risk there. But he is less of an expert on the service side like Tim Cook was. But I think it's an interesting hire for Apple because there's been a lot of talk about how Apple has lagged in AI capability, and we'll see what he does to address that. One last thing I'll say about Apple. They are spending less in CapEx this year, capital expenditure, than they did a few years ago. Less. We all know about Google and Meta and Microsoft that, have ramped up their CapEx 10, 15, 20-fold. Apple's not spending any money. The advantage of that is they still have a stellar balance sheet, tons of free cash flow. They can buy back stock. They're very flexible. They want to make an acquisition. I think the risk factor for Apple is that they're betting that their devices will still be the preferred way that we access the internet, AI, and all the rest. If there's a world where we don't need devices for AI, that could be interesting for Apple. We'll see. I think that's the risk. It's a technological risk. But for now, 2.5 billion devices are still out there, and Apple has responded to that. Also, the valuation has popped back up. So it's not as attractive from a valuation standpoint as it was, a few weeks ago. Chase talked a lot about CapEx ramp up at Amazon and Google last week. So I'm not going to get too much into that, but I think Amazon's quarter was very interesting. That stock is at an all-time high now, after being down over 20% at one point for the year. Amazon has been very much a Mag 7, Magnificent 7 laggard. But again, like I said, part of it is their core, growth and profit engine. AWS, Amazon Web Services, accelerated up to 28% growth year over year. According to Deutsche Bank, that was their fastest growth in 15 quarters. So that really, I think, is the driving force behind their stock ramp up. But I think there are a couple other things going on with Amazon that I found very interesting. One is people don't often talk about their advertising business. And I've made the point over the years that is a kind of a sneaky, as my kids would say, a sneaky source of growth for them. Their advertising business, according to Deutsche, now generates more than $70 billion. $70 billion in trailing 12-month revenue. And it's still compounding in the low 20s. In fact, in the most recent quarter, it reached 24% growth year over year. That's the fourth consecutive quarter of more than 22% growth. So I think that's very interesting because for a couple reasons. One is I think there's room for that to pick up some of the slack if they do run into some competitive, pressures with their AWS and other growth engines, or if we get a slowdown, in consumer spending. But it's also a high margin business. It's one of the most profitable business lines that they have. So that is going to help their multiple if that keeps going the way it's going. The other thing that I felt was interesting is they announced, I think it was just this week, that they're going to threaten FedEx and UPS, I think, in a more significant way. They're already, of course, a dominant force in the global supply chain, but now they're going to go more head-to-head with them. And that's going to be very interesting, where they're going to actually compete more with those companies to do business on non-Amazon, or I guess I should say shipments beyond, Amazon deliveries. We'll see how that goes. I think the great thing about it is they already have the logistics network, right? I mean, they already have the routes and the distribution centers and the warehouses. And of course, they're using AI to get more efficient with those processes. But they're going on the offense there, and we'll see what happens. So Amazon, the obvious risk with Amazon is they are competing neck and neck with Google and Microsoft on the cloud side. They are spending gargantuan amounts of money, as Chase mentioned, and we don't know quite yet what the ROI is going to be on that, right? That's the big kind of unknown over the next few years. So there are definitely risks to the story, but Amazon has a lot of levers that they can pull, and I think it's probably the most interesting it's been in some time. Wanted to mention Uber. I mentioned Uber a fair amount over the course of the last year. I think most of us are aware of kind of the competitive pressures. Everybody is getting into the autonomous vehicle space. I mean, of course, Tesla's involved, Amazon's involved. We know that Google's involved through Waymo. There are other people involved as well. It's a very competitive space, and we just don't know how it's all going to turn out. Uber's approach has been to kind of sign as many deals and diversify their exposure as possible. So they're striking deals all over the place to provide kind of logistics and operational excellence to a lot of these other platforms. Not so much Tesla, but certainly Google and Amazon and Rivian and others. So they're basically trying to get as many bullets in the chamber as they can. So we'll see how that turns out. That's probably the biggest headwind. But in the meantime, Uber's execution has been pretty darn good. Again, from Deutsche Bank, they looked at their most recent quarter. I mean, check out these numbers. I mean, gross bookings, you can probably credit my college daughters for this, for handling most of this. Gross bookings were up 21% year over year. Total trips grew 20% year over year. I mean, these are huge numbers for a company that's already doing over $50 billion in booking revenue, right? And this is, absorbing terrible weather, geopolitical disruption, gas price volatility. They are putting up huge growth numbers in their core business. I would go so far as to say it's accelerating demand. And meanwhile, their margins also have improved. So, for a time there, Uber was willing to sacrifice margins in order to grow, but they're not doing that right now. They're able to continue to grow and still be extremely profitable. So I would also lastly argue that, Uber was over $100 a share. Now it's in the high 70s. Their valuation for a company of their size and their growth rate is probably one of the cheaper stocks in the S&P 500. It reminds me a lot of Google a year ago, before Google exploded. Google was trading at a discount to the S&P, similar type of growth metrics. I'm not saying that Uber's about to go up 70-some%, but I do think the risk-reward trade-off is compelling. But like I said, be very aware of the competitive risks that they have. Just a couple tweets from Elon Musk at Tesla is enough to send the stock down 5%. So you have to be careful with it, and you have to be patient with Uber. The one other kind of space I wanted to mention, we've talked a lot about what I would call electrification. I think all of us know that data center, build out, particularly here in Northern Virginia, is explosive. We know that data centers require a ton of power, but it's not just that. You're seeing utilities across the country work to upgrade power grids because we have an archaic power grid system in this country. Some of these things haven't been improved for 50, 60 years, literally. So we've tried to get some leverage to that. We own many of our client portfolios, GE Vernova, which is, of course, a spinoff a few years ago from General Electric, right? We all know General Electric. What's amazing about GE Vernova's quarter, and I would say the stock has already responded to this, is their CEO came out and said that we're essentially, for example, their heavy-duty turbines, we're essentially sold out through 2029, almost into 2030. Sold out. Okay, so they have unbelievable demand for their products. They are involved in a number of different kind of elements of the food chain, if you will, in terms of energy supply. Now, of course, sold out doesn't mean that these orders can't be canceled, right? I mean, we saw that during the dot-com era where people reneged on contracts all over the place. The nice thing about Vernova's order numbers is because up to 25% of the cost of a turbine, for example, there has to be a down payment for that. So, quote-unquote firm commitments, commitments that they're already receiving payment for, almost 44% of their order book in general in the first quarter. So they're getting a lot of money up front in a way that companies did not get in the internet build-out, 20-some years ago. I think that, the risk to GE Vernova would be the risk for all these names that you get a real pullback in CapEx at some point from the big hyperscalers or utilities or other people looking to build these systems out. And second would be valuation. The stock has doubled over the course of the last, 4, 5, 6 months. And as a result, the valuation is no longer, sort of a value type valuation. But, keep an eye on GE Vernova. It is a very interesting name in a very explosive space. Might be the type of thing that you'd at least take a look at on a correction, or were to pull back. Along those lines, Eaton, E-A-T-O-N, that's another name that we added in many portfolios. And again, I own all of these in my own portfolio. Consider that a conflict. Eaton, symbol ETN, very interesting name because they've really transformed their business. A few years ago, they were a pretty boring company, if I'm being honest. Low margins, low growth, low valuation, kind of a nuts and bolts electrical equipment supplier. But somewhat similar to GE Vernova, they've really latched onto this electrification theme. And they came out with their earnings the other day. I think what's interesting there is and we've said this about a lot of companies, I just said it about Uber, their business has exploded before they really figure out the economics. In other words, their revenue growth was dramatic in the quarter. Explosive demand for their orders. Problem is, it costs money for them to manufacture these and build these out and ship them and deliver and install and all of that. So their margins have not kept up with their revenues. In fact, their margin growth actually contracted in the quarter. Now, this was not a surprise. Wall Street had largely modeled for that. But I was looking at a piece from Goldman, and they were saying that come later this year, maybe more so 2027, they expect that to inflect. The stock has actually been a bit of a dog over the past couple years versus some of their peers, and I think it's for that reason. But we just got involved for many clients just in the last couple months. If you're willing to be patient and you think that they can operate a little bit better on the bottom line, then the story becomes more compelling. But that's the same as the risk with GE Vernova. There's an overall macro risk with AI spending, but also an execution risk. Last one I just wanted to mention is Visa. Haven't talked about Visa recently, symbol V. I've made the point over the last 6 months that Visa was trading at one of their lowest premiums to the S&P in almost a decade. So I've never argued that Visa was a cheap stock. You've always paid a bit of a premium valuation for their stellar growth and 70+% profit margins. But that margin or that premium had shrunk significantly over the past 6 months. And they've had a lot of headwinds, right? Conflict in the Middle East, tariffs, right? High gas prices, Trump rhetoric that, quite frankly, has scared a lot of international tourism, both coming and going. So Visa's had a lot of things to contend with, not to mention disruption in the whole fintech space. All these, companies that have come up, over the course of the last year, payment platforms and the like. But their earnings are pretty darn impressive. According to Raymond James, their earnings beat significantly, revenues beat significantly, and in fact, revenues increased up to 15% year over year. That was their best year over year quarter since 2022. So that was pretty impressive. Stock responded positively. The stock is still trading at a discount to the normal premium. So might be this type of stock that you'd take a look at on any sort of pullback. We'll see what this summer brings with World Cup soccer and, of course, the Olympics coming in the not-too-distant future, whether that's an additional tailwind. There's always the macro risks with Visa, right? I mean, transactions and consumer spending in general. And there's also the competitive threats from, like I said, some of these startup payment platforms. But so far, Visa appears to be weathering that storm. All right, there are other names that we'll probably get to over the course of the next couple of weeks. We'll see what happens overseas in the Middle East. Stay tuned for that. I hope this was helpful. And as always, I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.